Welcome to Stock Incubator. Today we are breaking down the market question behind the story. The market just absorbed a weak jobs report, a wobble in expensive tech, a fresh bid in gold, and a global rotation in risk. Now comes the harder part. Next week forces the market to decide whether that move was a one-week shakeout or the start of a deeper regime shift. Fed minutes arrive. Earnings commentary starts, giving us a cleaner read on the consumer. Housing gets another test. And every one of those signals lands after a week that already shook conviction.
The market just absorbed a weak jobs report, a wobble in expensive tech, a fresh bid in gold, and a global rotation in risk. Now comes the harder part. Next week forces the market to decide whether that move was a one-week shakeout or the start of a deeper regime shift. Fed minutes arrive. Earnings commentary starts, giving us a cleaner read on the consumer. Housing gets another test. And every one of those signals lands after a week that already shook conviction.
The reason next week matters is simple. The market has already priced the first emotion. It has not priced the second conclusion. Traders reacted to weak payrolls. Investors still need confirmation on growth, policy, and demand. That makes next week a proof window. If the new data lines up with the slowdown narrative, the rotation extends. If the data refuses to confirm it, the market can snap back fast and punish anyone who overread the jobs shock.
The first checkpoint is Monday. S&P Final Services PMI and the ISM Services report both land early in the week. After a weak payroll print, the services side of the economy becomes critical.
Why?
Because services have carried a huge share of the post-tightening resilience story. If services remain firm, the market can argue that payroll softness was a warning but not a breakdown. If services crack, the slowdown case gets much harder to dismiss.
Tuesday's trade balance will not move markets by itself, but it adds texture to the growth picture. When the macro desk backdrop gets fragile, secondary releases matter more because they help investors judge whether weakness is broadening. A soft trade picture would reinforce the idea that momentum is fading. A sturdier print would argue that the labor shock has not infected everything else yet.
Wednesday is the centerpiece. The minutes from the June 16 to 17 FOMC meeting arrive at 2 p.m. Eastern. This is where investors try to separate headline policy from internal conviction. The market wants to know three things. How worried were officials about growth? How sticky did they think inflation still was? And how divided was the committee about the path ahead? After the jobs miss, those questions matter more than usual, because the market is looking for permission to believe easier policy can come without a deeper macro desk accident.
The same day also brings consumer credit data. That may sound minor, but it is not irrelevant. Slower job growth and tighter credit conditions are a dangerous combination when households are already carrying more financial pressure. If credit growth looks weak, that can reinforce the idea that consumer resilience is thinning. If it holds up, the consumer story stays alive a bit longer.
Thursday brings another clean read on the economy. Initial jobless claims hit in the morning, and existing home sales follow later. Claims matter because they offer the fastest fresh signal after the payroll shock. Housing matters because it remains one of the most rate-sensitive parts of the economy. This is where the macro desk story gets sharper. If labor continues to soften and housing stays weak, the market will have a hard time pretending that all the damage is confined to one report.
Housing deserves its own chapter because it carries both emotional and economic weight. Zillow's latest forecast still points to a housing market that looks flat to fragile rather than healthy and rebounding. That is not a housing crash call, but it is a reminder that the market is still stuck between affordability pressure, stubborn mortgage costs, and fragile buyer confidence. If housing continues to weaken, it becomes a direct challenge to the soft landing narrative.
Next week also starts the next layer of the earnings conversation. Delta Airlines and PepsiCo help open a read-through on consumer health. These names matter because they touch different parts of household behavior. Delta speaks to travel appetite and discretionary resilience. Pepsi speaks to staples demand, pricing, and whether the consumer is trading down or holding up. Markets do not need blockbuster numbers from either one. They need honest commentary. That commentary can move the entire demand narrative.
The real equity question is whether leadership broadens or breaks. If next week's macro desk data stays soft but not ugly, the market may keep rotating rather than collapsing. Gold can stay firm. Selective cyclicals can breathe. India and other rotation beneficiaries can keep attracting capital. But if the data turns from soft to sour, leadership narrows again and high multiple names face another round of pressure. That is the trap. Bulls want cooling growth. They do not want falling demand.
Cross-asset behavior will matter just as much as the headline releases. Watch whether yields keep easing. Watch whether the dollar stays on the back foot. Watch whether oil remains firm near the low 70s for Brent and high 60s for WTI. Watch whether Bitcoin and Ether can stay steady. Those markets often tell you whether investors see a controlled slowdown, a policy pivot, or a more disorderly loss of confidence.
The bull case is that the market gets exactly what it wants. Services stay okay. Fed minutes sound cautious, but not alarmed. Claims do not jump. Housing stays weak without collapsing. Delta and Pepsi confirm that the consumer is slowing, not snapping. In that world, lower yields support speculative parts of the market, the rotation becomes healthier, and the week ends with investors believing the economy is cooling into easier policy rather than slipping into a real scare.
The bear case is that every weak point lines up at once. Services soften. Claims drift higher. Housing disappoints again. Fed minutes reveal more anxiety about inflation than the market wants to hear. Delta and Pepsi caution that the consumer is tiring. If that cluster hits together, the market gets trapped. Stocks lose the soft landing cushion. Gold keeps the upper hand, and rate cut optimism starts looking less like support and more like a response to genuine weakness.
What would break the cautious setup? Stronger services, calm claims, and earnings commentary that says demand is stable could invalidate the slowdown scare quickly. What would confirm it? Another soft labor-adjacent signal, weak housing, or consumer commentary that sounds defensive. That is why the cleanest approach is not to predict one dramatic outcome. It is to watch whether the evidence keeps stacking in the same direction.
Next week is not just another trading week. It is the first serious test after the market's rotation shock. Fed minutes tell us how the committee was thinking before the labor miss changed the tone. Earnings commentary tells us whether the consumer is still spending with confidence. Housing tells us whether higher rates are still biting. Claims tell us whether labor weakness is spreading. Put those together, and you have the week's real question. Does the rally survive the proof window, or does the market walk into a trap? This content is for educational and informational purposes only. It is. We do not provide recommendations to acquire or dispose of any security, nor do we issue valuations or future valuation forecasts. Please consult a certified financial professional before making investment decisions.